All right, everybody, welcome back. So in this video, we're going to talk about a trade that I was in that was not working out too good. And then I made an adjustment and now it's working out a little bit better. All right, so this trade was done in the DOW, right? Dow Incorporated. And you can see we had a trend line breakover. And so I had put on a trade. Let's first walk through what the trade was that I was originally in. So I had a vertical trade here, the 70.80. This was a call debit spread out of the money. And you can see we're not yet even close to the $80 area, right? But we are above that $70 area. So the original trade, I paid $1.12 for it. That was $112. That was back in November. And after I got into the trade, here we are in April 11. Things weren't working out, so I closed the short leg of that option, right, the 80 strike. When you sell a call and price does not get above it, it decays. You get profit from that. So I closed the trade down, and that left me in a long call that I really didn't have any hopes of seeing any return on. It was just a long call that didn't have any profit left in it, and I figured, well, why close it? We'll just hang on to it. If we go back in time and look at what was going on back in November when I put the trade on 11/12, it was that day right there. So let's just add a little more time to the chart. All right, we'll go back to November 12, right there. So I got in looking for a breakout, and of course it dumped down beyond that. This was a completely losing trade. And I salvaged the 80, closed that down, and kept that $70 call. Now, you know, that's a bag hold, right? It was a losing trade. There was no reason to close it, so I just left it on there. And here we are, later in the year. I've still got this June 17 call, and its value is $117. At least that was my cost for it after the roll. All right. Right now, I can close the trade and make $193 profit. So I got my 112 back that I spent, and the net gains after everything is said and done would be $193. Now I could do that. Just take my money and walk away. But what else can I do? Because we can always close, right? That's not much of a discussion. But what if we break through this major level of resistance that we're looking at here on the chart? Now, everybody gets into this situation. They say, well, I want to lock in my profit because I'm scared that this is going to go down again and I'm going to lose all my money. So why don't I just close it down, take my money, and leave? Well, I could do that. But what if it breaks through after I close it down and this thing continues to go to like 85 or 90? You know what will happen at that point? I'll be saying, oh, I should have kept it. Why did I close that trade? I could have made so much more money. Well, how do we stay in this trade and make sure that I don't end up in a loser? Well, what if I put some of this profit on the line? Realize what I just said, put profit on the line, not capital. So the money that I spent last year, I've got that money back. That's mine. What if I lock in that profit, take my money back, still leave the trade on, and see what else we can get? So let's go to the options tab and take a look at what I could do for that. Now we got earnings coming up today, right? Go to the earnings here on Dow. So we can see that there's earnings that was reported. That's where all this volatility came in, and that's where the spike came in. This could continue to do good, or this could be the end of everything, right? So if I need to cover 112 first, what could I sell for $112? Think about the shape of a debit spread. If we just wanted to put on a debit somewhere, how would we put on a debit? We would buy one near the money and sell one farther away from the money. That's what a debit in its structure looks like. Well, I've already got the long call. What if I added a short call here for $183? If I sell that at 183, I get my 117 back, and now I'm in a trade that has the opportunity to make more money. How much more money could I make? Well, if things continue to go good, this is a $2.50 wide trade, I could make that 2.5 plus the 183 that I'm already holding. That's a reasonably decent amount of money. No matter what, I would be in a no-lose trade at that point, right? Nothing could happen that would take away the profit that I've already got. Because if I have a long call for 117 and I add a short call for 183, my minimum profit value would be the difference of those two numbers. My maximum profit number would be $2.50 plus $1.83. So let's get the old calculator out and crunch some numbers here. What's my gains? So we take the 183 minus the 112, or yeah, we'll use the 117. And that gives me $66 of guaranteed profit. Now you might be looking at that saying, why would I be willing to take this $66 when I could just close the whole thing right now and get $193? Well, I mean, don't get me wrong, the 193 sounds good. But what else could I get? Right? Could I get more for this? And that's the whole idea of trading, right? That we can take our minimum profit and we can go home, but then we can also leave more on the table and maybe get more out of it. I would be in a no-lose trade with a minimum guaranteed profit of $66. But I could stay in the game and perhaps get more than that $66, knowing that no matter what, I will at least make that $66, minus commissions and fees and all, the resort fees. Got to pay the piper, right? You got to pay to play. So maybe I'd get 60 out of that $66. But I would in no way be in a situation that I would lose money, right? That's the main point. So I wanted to make this video kind of point out, when it comes to managing trades, winners and losers, there's a lot on the table, right? There's a lot to be desired. Now, one of the reasons that I even have this opportunity is that I wasn't trading in a short duration. When I put this trade on back in November, it was for June of this year. Okay? It was a $10 wide trade. So at the beginning, when I first got in, I was risking $1 to make $900. I didn't get that, and I closed down the short leg, leaving the long leg exposed, and here we are later on. Everything's turned back around, right? Now, it could have just gone into oblivion, and I would have lost my money, and that would have just been $100 down, but I risked $100 to make $9, and that didn't quite work, but I'm now back up into profit. And now that I'm in profit, we can look at it again and say, well, what else can I do with it? So let's just cancel this order for a moment and say, well, what else can I do with it? Things in the short duration benefit a lot more than things in the long duration. So what if I rolled my strikes, right? If we take that call a lot closer to the current location in time right now, could I get a locked-in profit and still hold the trade? Yes, I can. You can see that right now they're offering me a trade of $171 in credit, which means I would be holding a long call for free, for credit. When you buy a long call, you spend money and you get a call. In this situation, they're giving me money and I have a call. And I would still have 15 days to expiration, and I would still have my long call that could continue to make more money. This would give me a guaranteed minimum profit of $51, and I could still go in and sell an option on that as well, right? So I'm going to throw that into the ring and see if we can get that one filled instead. I kind of like this one. This one's going to get me out of the game sooner. I will be, completely done at that point in 15 days rather than in June. But on the other side of that coin, I'm kind of ready to get out of this anyways, right? I'm ready to move on and do something else. So I'm working the order to get that filled. Maybe we'll give them a little nudge, kind of help them out. So once we get that filled, once I have that long contract much closer in, there's a few things that I can do. Did you notice that it was going down from here, right? So one thing this tells me is that I could sell short duration calls on an intraday basis and make money from that, right? Now this account has to worry about PDT, so I wouldn't necessarily want to go in and day trade short calls here, but I could. I could also look at this and say, well, I'll just sell a swing call on this thing, sell one for Friday, and then sell one for next Friday, and yet again, make more money, right? It gives me a way to stay active, to participate, to take what I've already got and make more from that without any exaggerated risk to the current situation, right? That's not a bad place to be. So we got to get the trade filled. I'm going to go ahead and force their hand, make them fill this trade. How do I do that? Well, I give away a couple dollars, right? There's not a lot of active traders here. That's one of the reasons that I'm having a hard time getting this filled. Let's look at what other contract I could use. Maybe there's some more liquidity somewhere else. Not really seeing a lot of liquidity in other places. This thing made such an exaggerated move today. Let's see. We'll go ahead and cancel that one. And we'll go in. And we'll just look at what it has to offer as we go down. What we're looking at is the credit here. So right now, if I rolled into June, which has a little bit of volume today, I would have $106 locked in guaranteed. I would still have 43 days to expiration. This would be a no-lose guaranteed locked-in trade that I would be a minimum profit of $100. And still, I would be able to sell an option against this. All right, so let's see what we get out of that. Maybe I can force that one since the other one's just not getting any. There's just no traders in there. All right. And when I talk about forcing their hand, the law says they have to take my order if I offer, quote, fair market value. And the way the market makers get around filling your order is they'll say, well, he didn't offer a fair price, and so we didn't have to take his trade. But I'm offering this roll and to take credit. Well, if I offer to take less credit, then I can continue to push them closer together. Also, look at the bid-ask spread. Notice how it's really wide. The midpoint is $74. And that's a long ways, right? This is a 20-cent wide spread. So we could argue that the midpoint has a lot of room to be negotiated and that I'm not necessarily giving away profit. Besides, if I can't get filled, then it doesn't matter anyways, right? We couldn't call it profit unless we actually get some money out of the thing. So I'm just slowly knocking the value down lower and lower, and then there we go. Okay, so now I locked in that trade. I'm holding a long call for $1 credit. Bare minimum, no matter what happens, I will make $100 on this trade. That's the least amount of money that I can make, and I cannot lose. Now, isn't that a nice way to go to sleep at night? Holding a trade that you know cannot lose money. Yes, please, I want more of those, right? So now I got this thing. What am I going to do with it? Well, I could just hold it. I've got 43 days to go. There's nothing wrong with just hanging on to it and letting the trade just work itself out. What else could I do with it? Well, now that I own the 75, I can actually go in and I can sell a 75 somewhere else. This one, for an example, I could sell this 75 and work the order, maybe get 66 more dollars of credit. Now remember, this put, or excuse me, this call is protected by the other call. So if the Dow continues to run and goes to 80 or 85 and my call goes in the money, my other call will be its protection. So I won't be on the hook, right? I may break even, I may not make any money, but I'll still get my original $100 and the short call just won't make me any profit. On the other hand, if I sell this and I close it back at profit, say $35, $40, and then I sell it again and I close it and sell it again and close it, I could take this $100 of profit and turn it into even more profit, right? Just a little bit at a time. Day trading or swing trading my way down into a better value. Now, if I'm willing to use some buying power, I can sell a higher value option, right? We're talking about selling the 75 because I have a 75. But what if I wanted to sell the 71? Well, if I'm willing to pony up the buying power, I could do that and I could get even more money. We would want to time it better, right? If you're going to do that, you want to be a lot more nimble about the choice or the selection that you use when you're thinking about selling, right? So let's think about selling. Now, when I demonstrate this, I always talk about how, what if we had a crystal ball and we could ask, say, the magic 8-ball, is this a good time to sell? Let's look at yesterday's stock and say, well, if I was day trading, where would be good places to sell a call? If we look at yesterday's chart and I sold a call here and then I bought it back here, that would have been a good place. And if I sold a call here, bought it back here, sold it there and bought it back there, sold it here and bought it back here. Now, obviously, looking back, that would have been a real easy thing to do. In the middle of the day, maybe not so easy, right? But what if I had just sold it originally at the beginning of the day after that huge spike up and we just failed from there? That would have been a good day to sell a call. Today would be a good day to sell a call. You can see how we set a high and we've been falling since then. It's very unlikely to rally back up today and challenge us. So if we sold a call today, that would be a good day to sell a call, right? When would we not want to sell a call? Well, on those days when we're really bullish. Suppose we flip this market over and look at what a bullish market would look like. So there we go. If it was a chart that looked like this, and we see that it's running to the upside, I wouldn't want to sell a call today. I would be worried that it would run me over, right? So a bullish day? Nah, I don't want to sell a call on a bullish day. Let's sell a call on a bearish day like today, right? Like when it looks like this. So there you go, guys. Just a short video. I wanted to kind of show you how we can take trades that maybe aren't working out too good and we can flip them over and kind of get our money back. Now, think about, before we go, think about my current situation. I originally did spend $112. Right now, this has a bare minimum profit if I hold all the way to expiration of $100. Well, I don't yet have all my money back, right? So I'm going to want to do something else. I could close the whole trade down right this moment and make a profit, or I could go in and sell some options against it and make sure I get that last $12 back, right? So that's it, guys. I appreciate your time and look forward to seeing you at the next video.